Go.
Good morning, everyone. My name is Preet Sekhon. I'm with Cost Segregation Services. Thank you for taking the time today. For the agenda for today's presentation, we're going to talk about real estate depreciation. We're going to talk about how that affects cost segregation, and we'll also go into the referral bonus because I know that's what everyone wants to hear about. So first things first, what is real estate depreciation? Am I losing money? Why are we depreciating our real estate? Real estate depreciation is the process of making a gradual deduction in the value of real estate until it becomes obsolete. This is a reduction to your tax liability. It's just a paper write-off. It's something the government incentivizes you with to invest in real estate that produces income. So it's just an expense on paper. The IRS allows you to reduce your taxable income through it. And again, it's just an incentive. It's a contract that the government gets into investors in real estate with to incentivize them to go into this space. A lot of jobs are created through real estate. A lot of businesses are supported by real estate. So the government's very much in favor of you investing in real estate. What types of buildings qualify? As you can see, pretty much anything, as long as it's producing income. So it can be multifamily business tower, it could be a factory, a hospital, a grocery store, anything that produces income that's also associated with real estate. So far, I went through that a little bit quick. Any questions on depreciation, please feel free to take yourself off of mute. Okay, we're all depreciation experts. Let's move on. So cost segregation, it's an engineering-based study. What we do is we segregate the building systems that allows us to accelerate the depreciation. So with the standard depreciation, you're taking the whole value of the building and you're taking just a bit of that every year, 3% on average per year. But with cost segregation, instead of taking that 3%, we're actually allowed to take upwards of 30% in the first year, therefore 10xing the amount of depreciation, taxable expense you can take against your income. Any questions on cost segregation? All right, perfect. So I wanted to run through an example because I think that would help make sense of how this all works. So we're looking at a building cost of $1 million. That building produces $250,000 worth of income. And the standard depreciation from that they're getting every year is about $33,000, reducing their taxable income to $217,000, which at the end of the day requires a tax bill of $80,000. So their take home is $137,000. So, the number just gets a little bit smaller as we kind of go across. So their take home is still $137,000, not a bad take home off of $1 million building. Now let's look at that example with cost segregation. So same building, same income. Now the depreciation is now up to $300,000. So the taxable income, since that $300,000 is larger than that $250 in income, your taxable income is now $0. Your tax bill is $0. So your take home is $250,000. And now let's look at those differences side by side. So again, if we look at the last number, the take home amount, in the first example, with your normal straight line depreciation, not using a cost segregation study, you're getting $137,000 of take home income. With the cost segregation example, you're getting $250,000 of take home income. That is a tax savings of $113,000. That's a valuable amount of money that a business can then reinvest into their employees, into further businesses, also into just growing with a new business. Any questions on the example?
Preet, I've got a question. I'm just curious. It seems like this is kind of front-loading deductions that you would get over time. I'm just wondering, what's the payback? Like, what happens in the second year? How does it come back around?
That's a great question. I appreciate Scott. So the payback in essence, is that depreciation is finite, right? The building costs $1 million. You cannot depreciate it $3 million. You can depreciate it $1 million. So what we're doing is we're, just like you said, we're front loading that depreciation, taking it now, and we're going to have to reduce our depreciation down the road. But if you're looking at, you're taking a lot of it now, you're just slowly reducing it back, slowly kind of paying it back over time. It's a nominal difference on the subsequent years, but you get most of it up front. Now, we all see what is going on in our economy right now with inflation. And so if you can get that money now while it's worth more, then we know it's going to be worth in the next 10, 20, 30 years. You can do a lot more with it. Plus, the time value of money, investing that money now and having that interest compound over the next 10 or 20 years is also valuable to you. Great question. Thank you, Scott. Any other questions on the example? Perfect. So let's talk about the referral bonus. So what we give is a 10% referral bonus for any closed business. And our studies range from $2,500 upwards of $50,000. I've got a current study out right now, proposal for $56,000 for a large business where we're going to save them 7 figures worth of taxable income. So that means the bonuses range for you guys from anywhere from $250 to $5,000 plus. You know, the world is our oyster. So if you know someone that has a income producing real estate asset, or even a tenant who has invested large amounts of money into upgrading their location, be it a dentist, a doctor, a veterinarian, send them my way, please. And just as a reminder from the referral of the week, CPAs. CPAs are a great referral source for me. They are the gift that keeps on giving. You know, they have clients that they can say, hey, look, we've got, you know, this large tax bill coming up. Let me put you in touch with my cost segregation specialist and see if they can help you out to reduce that tax bill. One thing that we're also doing to incentivize our CPAs into at least talking to us is we're giving away free CPEs, continued professional education. So they've got to get a certain amount of these per year, just as we do with our CEU, our own educational credits for BNI. So this is a great way for them to also, one, learn about cost segregation, and 2, get that continuing professional education credit that they need as well for the year. And with that, my presentation is finished. A little bit shorter this time, but I wanted to leave room at the end for any questions, for any discussion. Please feel free to take yourself off of mute and ask any questions that you might have.
Preet,
Yes, ma'am.
I have lots of questions, but I just texted you. I don't seem too stupid to everybody, but just one question right
Sure.
now. So I have a friend with a property in Aspen, and she was renting it out, but they've changed the laws now that it has to be 30 days or more.
Right.
So it's a second home. Is there any reason she should talk to you?
100%.
Great.
So
I'll put you in touch, but tell
perfect.
me why.
So it's an income producing asset. So the government allows you to depreciate it, therefore reducing your taxes. It would be amazing if she could still rent it as a short-term rental, because it sounds like that's what she was doing previous, because there's a lot more use of that deduction. But yeah, for sure, it's a person that definitely wants to talk and figure out if this is a good fit for them.
Okay, great. Thank you.
No, thank you. Anybody else? Any other questions I can answer? Any friends? Questions? Going
Great
once?
presentation.
Hey,
Thank you.
Preet, are you there still?